What is a ledger? Why is it important in accounting? How does it fit into the accounting cycle? Types of ledgers: personal, real, nominal. Ledger format and structure including T account and Dr. CR columns. Relation between journal and ledger and how transactions flow. Ledger accounts are fundamental components of accounting. They serve as the backbone for recording and organizing financial transactions. There are three main types of ledgers: personal, real, and nominal. Personal ledgers deal with individual accounts such as customers and suppliers. Real ledgers, on the other hand, are concerned with assets and liabilities including properties, machinery, and loans. Nominal ledgers focus on income, expenses, and capital accounts. The format and structure of a ledger are crucial for maintaining accurate records. Typically, ledgers are organized in a T account format, which visually separates debits, Dr., and credits, CR. This format helps in easily identifying the nature of each transaction and ensures that the accounting equation remains balanced. Each ledger entry includes a date, description, and the amount debited or credited. Understanding the relationship between journals and ledgers is essential for grasping the flow of transactions. Initially, transactions are recorded in a journal, also known as the Book of Original Entry. These journal entries are then posted to the appropriate ledger accounts. This process ensures that all financial activities are systematically documented and can be easily traced back for verification and analysis. The flow of transactions from the journal to the ledger is a critical step in the accounting cycle. It ensures that every financial event is captured accurately and reflected in the company's financial statements. This meticulous process aids in financial reporting, auditing, and decision-making. By maintaining well-organized ledgers, businesses can track their financial health, identify trends, and make informed, strategic decisions. In summary, ledger accounts are indispensable tools in accounting. They categorize and summarize financial data, providing a clear picture of a company's financial position. Whether dealing with personal, real, or nominal accounts, understanding ledger formats and the transaction flow from journals to ledgers is key to effective financial management. How to post entries from journal to ledger. This process is crucial for maintaining accurate financial records and ensuring that all transactions are properly accounted for. In this guide, we will walk you through each step, providing detailed explanations and practical tips to make the process as smooth as possible. Whether you are a seasoned accountant or a beginner, this guide will help you understand the intricacies of ledger posting. Real-world examples and scenarios, like business transactions recorded in ledgers. Imagine a company purchasing office supplies. The transaction is first recorded in the journal, detailing the date, amount, and accounts affected. This journal entry is then posted to the ledger, where it is categorized under the appropriate accounts, such as office supplies and cash. By doing this, businesses can track their expenses and revenues accurately, ensuring that their financial statements reflect the true state of their finances. Another example could be a customer making a payment on their account. This payment is recorded in the journal and then posted to the ledger, updating the accounts receivable and cash accounts. These real-world scenarios highlight the importance of accurate ledger posting in maintaining financial integrity. Debits and credits in the ledger with some easy tricks to remember. Debits and credits are the foundation of double-entry bookkeeping. A debit entry increases asset or expense accounts, while a credit entry increases liability, equity, or revenue accounts. To remember this, think of the acronym DEALER. Dividends, expenses, assets, deal, are increased by debits while liabilities, equity, and revenue, LER, are increased by credits. This simple trick can help you quickly determine how to record transactions in the ledger. Additionally, always ensure that the total debits equal the total credits for each transaction, maintaining the balance in your accounts. By mastering debits and credits, you can ensure that your ledger is accurate and reliable, providing a clear picture of your financial health. In this chapter, we will explore the essential ledger entries for a small business. Understanding how to record transactions accurately is crucial for maintaining financial health and ensuring compliance with accounting standards. Let's start with a common transaction: cash sales. When a business receives cash from a customer, it needs to record this in the cash sales ledger. This entry will show an increase in cash and a corresponding increase in sales revenue. Next, consider a purchase on credit. When a business buys goods or services on credit, it records this in the purchases ledger. This entry will show an increase in inventory or expenses and a corresponding increase in accounts payable, indicating the amount owed to suppliers. Another important transaction is rent payment. When a business pays rent, it records this in the rent expense ledger. This entry will show a decrease in cash and a corresponding increase in rent expense, reflecting the cost of using the business premises. Finally, let's look at salary payments. When a business pays its employees, it records this in the salaries expense ledger. This entry will show a decrease in cash and a corresponding increase in salaries expense, representing the cost of labor. By accurately recording these transactions, a small business can maintain a clear and accurate financial picture, which is essential for making informed business decisions and ensuring long-term success. Now, let's see how these transactions appear in different ledger accounts. Mistakes beginners make when posting to ledgers. How to cross-check and balance ledgers. Recap of why ledgers matter in accounting. Next steps in the accounting process.